Here's something that should genuinely unsettle you. The bank doesn't actually have your money. Not all of it. Not most of it, most of the time. The number on your banking app, that comforting little figure sitting next to checking account balance, isn't a pile of cash sitting in a vault with your name on it. It's mostly a number on a ledger, backed by the promise that the bank will be able to get you that cash if you ask for it. Most of the time, that promise holds. Sometimes, historically, it hasn't. And the entire system was built on purpose to function this way, to take the money you deposited and lend most of it back out to someone else, often within days of you depositing it. This isn't a conspiracy theory. It's not some dark secret whispered about on finance forums. It's literally how modern banking is designed to work, and it has a name: fractional reserve banking. Let's actually break down what that means, why it exists, and why the rules around it changed dramatically in 2020 in a way almost nobody noticed. You deposit $1,000, the bank keeps a fraction. Here's the basic mechanic. You walk into a bank and deposit $1,000. In the traditional version of this system, the bank was required to keep a percentage of that, say 10%, sitting in reserve, either physically in the vault or held electronically at the central bank. The other 90%, $900 in this example, the bank is free to lend out to someone else entirely. A mortgage, a business loan, a car loan. That $900 doesn't just vanish from existence once it's loaned out. The person who borrows it spends it, buys a car, pays a contract, or whatever, and that money typically ends up deposited into another bank account somewhere. That second bank now holds a new deposit, keeps its own fraction in reserve, and lends out the rest, and the cycle repeats. This process is sometimes called the money multiplier effect. Through repeated rounds of lending and redepositing, banks across the system collectively expand the total money supply well beyond the original deposit. Your original $1,000 deposit, through this chain reaction across multiple banks, can end up supporting many multiples of that amount in total deposits circulating through the economy. Read that again, because it's a genuinely strange fact about how modern money actually works. Banks don't just store money. They create it, in a very real economic sense, every single time they issue a new loan against deposits that aren't fully backed dollar for dollar. This isn't new. It's older than you think. This isn't some recent banking innovation cooked up by Wall Street to squeeze more profit out of you. The roots of this system go back centuries. It traces back to goldsmiths, who would hold people's deposited gold and silver coins and issue paper receipts in exchange. Those goldsmiths eventually noticed something important. Depositors almost never showed up all at once demanding their gold back. There was always a buffer of unclaimed deposits sitting idle. So the goldsmiths started lending out portions of that gold to other people, charging interest, while keeping just enough on hand to cover the day-to-day withdrawals they actually expected. Fractional reserve banking was essentially born from that observation. In the United States specifically, the National Bank Act of 1863 formally required banks to keep reserves on hand, specifically to protect depositors from having their funds gambled away entirely on risky investments. The reserve requirement was never meant to guarantee every depositor could get their money back simultaneously. It was meant to provide just enough of a cushion that ordinary everyday withdrawal patterns could be handled smoothly. The twist almost nobody noticed. Here's where this gets genuinely wild, and it's recent enough that most people have no idea it happened. On March 26, 2020, the Federal Reserve reduced the reserve requirement ratio for all banks in the United States to 0%, essentially eliminating reserve requirements altogether. Read that number again. 0%, not a smaller cushion, 0. As of that date, U.S. banks are not legally required to hold any minimum fraction of your deposits in reserve at all, and as a bank customer, you almost certainly didn't notice this happened because nothing about your day-to-day banking experience visibly changed. So why did this happen, and why hasn't the entire system collapsed into chaos? The official reasoning was tied to the early COVID-19 crisis, giving banks maximum flexibility during an extraordinary economic shock. But the deeper reason is that reserve requirements had already stopped being the Fed's primary lever for controlling the banking system years earlier. The Federal Reserve now relies on what's called an ample reserves framework, where it pays banks interest directly on the reserves they choose to hold, rather than forcing them to hold a specific minimum through regulation. In plain terms, instead of legally forcing banks to keep cash on hand, the Fed essentially bribes them into doing it voluntarily, by paying interest on whatever reserves the banks decide to keep. Even with no legal requirement at all, large banks still typically choose to maintain somewhere around 10 to 20% of deposits in liquid assets, voluntarily, because it's good business practice and keeps regulators and risk managers comfortable. So functionally, very little changed in practice, but symbolically, this is a huge shift. The entire premise that banks are required by law to keep a meaningful chunk of your money sitting safely in reserve quietly stopped being true years ago, and almost nobody talked about it. So why hasn't this caused constant bank runs? If banks aren't required to hold much of your money in reserve, What stops the whole system from collapsing the moment people get nervous and all try to withdraw at once? A few layers of backup exist specifically because of this risk. The Federal Reserve acts as a lender of last resort, able to lend money to solvent banks facing short-term liquidity shortfalls through emergency facilities and the discount window, which prevents a temporary cash crunch from spiraling into an actual bank failure. On top of that, banks are required to maintain capital buffers, equity contributed by shareholders, above a minimum percentage of their assets, with large U.S. banks needing a common equity Tier 1 ratio of at least 4.5% to 7%. This equity is designed to absorb loan losses before depositors are ever put at risk. And then there's deposit insurance. Government insurance protects depositors up to $250,000 per account, which is specifically designed to maintain public confidence in the banking system, because the entire fractional reserve model only works smoothly as long as depositors trust they can get their money when they want it. That trust is, in a very real sense, the actual reserve backing the system, not the cash in the vault, the belief that the cash will be there if you need it. Why this matters? More than it sounds like. This isn't just trivia about how banking technically works under the hood. It explains something most people experience constantly without ever connecting the dots. Why banks are so aggressive about getting you to deposit money and so much less excited about you withdrawing large amounts of it in cash. Every dollar sitting in a deposit account is a dollar the bank can potentially lend out for profit. The interest the bank charges on a loan is almost always dramatically higher than the interest it pays you for the privilege of holding your deposit. And that gap, multiplied across millions of customers and trillions of dollars in deposits, is one of the most fundamental profit engines in the entire banking industry. It also explains why bank runs, when they do happen, spiral so fast and so catastrophically. The system was never designed to survive everyone wanting their money back at the same time. It was designed to survive the normal, staggered pattern of withdrawals that happens when people trust the system enough to not all panic simultaneously. The moment that trust cracks, even briefly, the entire fractional structure underneath it gets exposed for what it actually is. The real takeaway? Your bank balance has never been a vault full of cash with your name physically attached to it. It's a number representing a claim, a promise the bank makes that, under normal conditions, it can absolutely keep, because most people never withdraw everything at once. Most of your money, the moment you deposit it, is already out the door, working as someone else's mortgage, business loan, or car payment. That's not a flaw hiding in the system. It's the entire system, functioning exactly as designed, the same way it's worked for centuries, just with the legal reserve requirement now sitting quietly at zero. The next time your banking app shows you a comforting balance, remember what's actually backing that number. Not a vault of your cash, but a chain of loans, a government guarantee, and the simple fact that everyone else hasn't asked for their money back at the same moment you did.